to navigate is that these reforms take time. First of all, completing the rollout of digitization of public finance management takes 7 to 8 years. And these are the lessons we've drawn from the experiences of some countries that have been there before. And we're also dealing with a number of challenges that have to be addressed, such as energy, connectivity to the internet, without which, obviously, there's ambition. We'll hit a snag. And these are the obstacles we are trying to address. And when we put these constraints together, we realize that we might be able to achieve our goal within 10 to 15 years. And a lot of efforts have been done with respect to digitization. And we are hitting a range of about 40% with the African people having access to the internet. And this indeed highlights the urgency for rolling out alternative solutions. And this is really the very purpose of this panel. So in addition to digitization, of course, we have all these issues related to exemptions, tax exemptions for that matter, better VAT administration. That is also a critical component because it accounts for about $89 billion potentially that we have to absolutely include in our domestic revenue collection. And of course, we have to combat illicit financial flows, tax evasion. That also is a critical component, and which in fact is a pool of resources that should otherwise help us to finance our infrastructure. So these are the three major pillars in our view that when it comes to domestic resource mobilization should help us leapfrog. Of course, we have the binding constraints that we have to address. Of course, we have to improve public finance management and the management of projects. Alain indeed raised the issue of bankable projects. That is beyond preparation. There is also the other issue that we need to have in financing our projects that should have a huge social impact and respond to the needs of the people. And there's also this path we have to embark on regarding strengthening public finance management, transparency, accountability, and strengthening oversight institutions that should perform regular audits. And this would help us to avoid waste that is all too common. And in that respect, specifically with public resources, so that we can make the most of that capital. Thank you.
Governor, I had to listen to my translation very well. I mean, Governor, just a quick follow-up question. So when you mentioned that, a lot of the tax exemptions and tax incentives, this quite large, and most of them are really with foreign direct investments, right? We don't see a lot of local direct investments benefiting from these tax incentives. And when we hear about digitization, it means that you're going to be bringing a lot of SMEs into the tax space. But the SMEs are crying. They're saying, you're not providing me the electricity, the water, the other services, but yet you want to tax me. So if you could just give the assurance to the SMEs that this brings them really into the tax base so that you are able to provide those basic services.
No, absolument.
No, absolutely. This is how it goes. Dialogue with SMEs is an engagement that helps us to clearly identify the weak points in the relationship between governments and the private sector, and specifically SMEs. And among the weaknesses we identified, financing, access to markets, access to financing, and access, obviously, to infrastructure to help them to deploy. So, with respect to access to financing, and specifically in the Central African Republic, we have established an ecosystem that would offer guarantees that would help the SMEs to, accelerate their access to financing. And in terms of market access, we established a new public procurement code that requires contracts to be awarded up to a certain threshold systematically to SMEs, and with a focus on gender, and so women and persons with disabilities. And thirdly, regarding energy, we are in the process of developing, and indeed the President of the Republic broached this subject during his presidential panel intervention at the opening ceremony of the annual meetings. And so it is the urgent presidential program to address energy issues, because we need energy to help the SMEs to deploy. And while we are responding to those urgent needs, we are concurrently looking at medium-term and longer-term solutions.
Thank you very much, Governor. The translation device has upset my mind.
Oh,
But Alan, you had started to talk about bankable projects. So let's continue that conversation. I mean, what are the key bottlenecks in building bankable project pipelines, and how can governments and partners accelerate project preparation to attract institutional investors at scale? I mean, I also, know that we co-sponsored, a side event on infrastructure asset recycling. So it's also a good opportunity to, reinforce all these different forms of creating bankable pipelines. Alan?
Yeah, thank you. Again, it's talking about the challenges, but I will pivot very quickly about opportunities. Challenges, I think we mentioned that. We talked about the high perceived risk. I actually would put perceived more than actual. There's actual risk for sure, but the perceived risk is much higher when we look at data. We acknowledge the risk, we have to work to reduce, but the perceived risk is higher than the actual risk. So that's the first thing. The second thing I mentioned is not enough, a shortage of bankable opportunities, especially at scale. And the last point that I'd like to highlight in terms of major challenge that is preventing mobilizing capital at scale is precisely because we are not focusing enough on domestic and regional capital mobilization. And the minister started to talk about what he's doing on the public side to try to mobilize more resources. But there is also the need to have much more focused approach to mobilizing domestic and regional capital from the market, from institutional investors. So the good news is that we are in the process of tackling those three challenges that I mentioned. But what we need to do is to do so with speed, and I would argue at scale. So when it comes to perceived risk, now we have seen how under the leadership of President Sidi Ulta of the African Development Bank, who is also my chairman, by the way, we are making a big effort to scale up ATD, which will be a very strong institution that will enable us to at least to provide political and regulatory risk mitigation. Together with other institutions, the World Bank has the PRG, AfDB also, but we need some African institutions to take the lead, working with other institutions. So RTD is one of the ways we're trying to tackle those perceived risks. Second point I mentioned is the not enough bankable investment ready project at scale. when you mobilize resources, you need to be able to offer instrument or investment-ready opportunities to investors for them to come in. And generally speaking, they don't want to spend too much time on project preparation and project development. So the good news is we're trying to tackle that by having Africa 50 project development, which is what we do to spend capital to develop projects. But we also recently launched the Alliance for Green Infrastructure in Africa, together with the African Development Bank as sponsor, Africa 50, and the African Union Commission, joined by regional and global partners to boost project preparation and project development. We're targeting to raise $400 million that will catalyze about $10 billion of private capital in infrastructure. So these are the kind of initiatives that we can implement to start to address project preparation and project development. It's not enough. There has to be a lot more focus on that, because the global pension funds, even the African pension funds, they won't come in the early stage. So somebody, DFIs, governments, institutions like Africa 50, sovereign wealth funds, we have to focus a lot more on project development and project preparation. And we are doing so, but my plea is that we should do so faster and with bigger scale. When it comes to domestic and regional capital mobilization from investors, honestly, we haven't done a good job enough in terms of focusing on that. Once again, the good news is that we are focusing on that now, and this domestic and regional capital mobilization is at the center of NAFAD, the new African Financial Architecture for Development launched by the African Development Bank under the leadership of President Sidi Oulta. It's about making sure that we're able to mobilize our resources. But to be honest, at Africa 50, we started that because we launched the Africa 50 Infrastructure Acceleration Fund. This is a $400 million fund, but out of 24 investors that we have today, 22 are Africans. African pension funds, African sovereign wealth funds, African insurance companies. Of course, the African Development Bank is one of our investors. And this is a blueprint as to how we can raise capital from within Africa, but also with global partners. But Africa is taking the lead. Africa is raising money from Africa. So my view is that we should do a lot more of that. And one of the instruments that we will be using to tap a bit more regional and domestic capital is what we call asset recycling. We had a roundtable on Monday, chaired by, actually, Solomon was the moderator, chaired by the president of African Development Bank, proposing asset recycling as a good tool to also attract capital from institutional investors, because it's about finding projects which are owned by government, but they are commercial in nature, and concession those projects. The proceeds of the concessioning will be used by government to reinvest into new assets. And then how you fund this process is by mobilizing capital from institutional investors from within Africa and globally. So these are some of the tools that we are using, not only to have bankable investment-ready projects, but to have them at scale. We have to move from the $100, $200 million project to the $1 billion project. Otherwise, we won't be able to attract capital at scale. So asset recycling, if you take, for example, bridge and roads across Africa, I believe we can put together a $1 billion, $2 billion plus vehicle with bridge and roads which have been de-risked, and in so doing attract institutional investors to fund these bridge and roads which have been recycled. So I'll finish on that. We have to execute transactions. We have to continue to discuss this, but we have to deliver on the ground transaction so that we can replicate those transactions and create a dynamic that will bring not only African investors, but global investors.
Okay. No, thank you very much, Alain. That was quite comprehensive. I mean, the African Development Bank was the architect of Africa 50, and maybe we narrowly focused on project preparation. Today, we have African institutional capital looking for risk assets. We also have governments, looking to actually have projects implemented. In discussions we've had, you've actually taken the thinking away from just project preparation on a standalone basis, private equity funds, and you've begun to move to platforms which are more permanent capital vehicles, mobility. So the idea that I've picked up is that, if we're going to do, mobilization of scale and with speed, the platforms gives us a mix of assets. So do you want to talk about that very briefly?
Yeah, very briefly, look, we've been doing projects here and there. $20 million equity investment, $30, $50 million equity investment. That is not going to move the needle. So we have to figure out a way to scale. And one of the instruments that we're implementing at Africa 50 is the platforms, or investment companies, we are calling them. It's about a way to aggregate a portfolio of projects across many countries to create scale, the type of scale that will attract investors. So you mentioned Africa 50 Mobility. This is our platform or investment companies for asset recycling for bridge and roads. We will concession a number of bridge and roads across Africa and launch a fairly significant transactions, asset recycling, within the mobility platform. So we will get African investors and global investors. Global investors will not come to our continent if we don't offer opportunities at scale. We need to aggregate. We need to stop doing projects. Well, we need to stop. We should continue to do projects here and there, but we should focus on a bit more scale. To move the needle, we need scale.
Okay. No, thank you very much, Alan. Alexandra, let me move to you. The World Bank Group, from the World Bank Group's experience in Congo, because you're based here, what investment climate reforms have most effectively unlocked private capital, and what lessons could be applied more broadly across the region?
Thank you. So in Congo, we've worked on several reforms, namely simplification of processes for opening businesses. I would say in the past 10 years, from 1,500, we have over 5,000 businesses that are registered in the Congo, which is significant for this economy. We've also worked on rationalizing licensing and inspection processes. We've supported the government in reviewing the investment code and the special economic zone framework. And then I would say looking to the future as well, at the IFC, we've started implementing in Africa in general and also soon in Congo, business councils, which are a forum for us to discuss with the private sector what are the bottlenecks for them doing business in their specific context, and using the World Bank Group platform, engage with the government on where we see things can improve. But I would say broadly, for a country like Congo, the solution is not necessarily big reforms, but delivering on a few fundamentals: macroeconomic stability, simple rules, reliable rules, anything that gives the investor predictability, reduces the cost and reduces the risk. Another issue as well is infrastructure, and I think you can say Congo, but you look all over Africa. Infrastructure is definitely an issue. We had the Congo Investment Day yesterday with the government, and the Minister of Energy and Hydraulics mentioned a few statistics. The energy production capacity is around 700 megawatts. The demand is 3,000. It's crippling for the private sector not to have proper infrastructure. We looked at the mining sector. The country is rich in iron ore in the north. How do you evacuate this if you don't have the proper infrastructure? So beyond reforms, there are some key, I would say, basic things that we need to provide to the private sector to help it grow. Thank you.
No, thank you very much, Alexandra. It's interesting. I mean, when people think about mobilizing capital with scale, we naturally go to large-scale transformational projects. But, your earlier points related to, creating the right enabling environment for SMEs,
Yes.
and they're the ones who also create jobs,
Yes.
primarily in our markets. So, you know, zero in on the SMEs in Congo as an example. I mean, what are some of the key enablers that would actually lead to greater SME development? Yeah.
For greater SME development, we need to better arm the financial sector to be able to provide the financing. We need to be able to, so for instance, at the IFC we have the small loan, the SLGP, small loan guarantee program, using blended finance to help de-risk financing to SMEs. But financing is not enough. You also need to help SMEs build capacity, make them more bankable, right? We have a program here that's called the Local Champion Initiative, where we try to identify local companies and we help them in terms of improving their skills in administration and being able also to provide a bankable or an attractive business plan, eventually for either IFC or another DFI to finance them. So it's really making the environment such that banks will want to finance them, so providing guarantees to banks to mitigate the risk, preparing banks as well to be able to analyze an SME, have the appropriate products for SMEs, and also preparing the SMEs themselves for this financing.
Okay.
Thank you.
No, thank you very much, Alexandra. Atmasu, I know you as an innovator, so this question really fits you. Which innovative financing or risk-sharing instruments have most effectively crowded in private capital for African infrastructure and trade, and how can they be scaled?
Well, the key word is scale here because capital has been flowing in. I think we're all very keen to see bigger flows, and we all know in our industry, people clamor all the time that, oh, capital is not a problem, we just don't have opportunity to deploy it. So there's really a sort of hurdle of the risk perception we always talk about. And I think there's measures that can be taken short, medium, and long term. And some, of course, will take time. But if one is talking about the next 12 to 24 months, the fastest moving measures that come to mind would be, I mean, there's not a whole lot that's new under the sun, as we say. It really is about helping reduce the risk enough for capital to flow in opportunities where it's sitting on the fence. And we know what those instruments are. It's buffering, it's credit enhancement, it's guarantees, right? Because you may have transactions that already, it could be a sovereign transaction, it could be an institutional transaction, it could be a corporate, or it could even be a project finance structure. Different types of counterparts all may have different needs at different points in time. Some of it may be recycling, which is a nice way of referring to refinancing. I mean, I think there's different types of capital that can flow quickly in a short space of time. And really what one has to do is just modulate the risk a little bit to sort of get them over the hump. And that modulation mechanism is what we've been talking about, right? There's different ways of doing it. I think something just that Alain has said that we found to be quite effective in the trade finance world is the aggregation point that Alain mentioned in infrastructure, where he talked about bridges and roads. The same principle applies in trade finance, where you can actually help banks that have hit their limits and can do no more with a whole range of clients, and you basically take assets off their balance sheet and you free them up to do more. And the way you do that is you create a fit-for-purpose vehicle And that vehicle will aggregate slices of different types of trade finance assets across the African continent, put it into an SPV, and then tinker with the risk return dynamics where you do roadshows, you talk to investors, you try to find what their sweet spot is. And then you do a little bit of buffering. You know, we all know what first losses are, second losses are. You can have a portfolio guarantee. There's many things you can do to sort of modulate the risk within a particular value proposition. So, I mean, that's something that also works, and that would be very much in line with NAFAD, because NAFAD is talking about systemic effects. So to get systemic movements beyond the small needle movements, one needs to look at who are the players in the landscape, find a way to free them up to do more, because that way you get the multiplier effect. So in trade finance, what we do is we go to a number of banks and we basically, try to offload a number of assets that they have. Now, somebody may say, why would they let go of good assets? We all know that there's something called fees in banking. So whenever you do new deals, you earn fees. The minute that the deal is on the books, there's no more fees in the same way, right? So that's the incentive for the banks to let go of those assets. Okay. So that initial sweetener has gone, and they're happy to chase new business, right? So that way, and what's in it for the global investors or African pension funds is, in addition to the aggregation that Alain has highlighted, there's something that happens when you aggregate. When you aggregate, you actually create a diversified risk profile, which is an additional benefit to aggregation for scale effects. You have the scale effect factor, and then you have the diversification factor. That can actually enable you to get a credit profile or a general risk profile that would help a number of investors develop appetite for investing in larger volumes. Sure. So I think these are the quicker moving measures, but I think we would be remiss today not to highlight that if we really want to open up the floodgates to capital, whether it's African institutional capital or global capital, we need to think of how we unleash our capital markets. Because the beauty of capital markets, as we know, is it's such a streamlined way of moving money, right? Whether it's equity markets or bond markets. And we have an example, the South African case. There's always been criticism of hot money coming in and out of markets, and that can create disturbance and instability. But you've seen a number of countries, that one in particular, that has had a very robust capital market, and you have foreign investors coming in and buying bonds in local currencies. So the investor takes the risk of the exchange rate effect, right? So they'll come in and operate through that mechanism and give a nice shot in the arm to the economy as a whole, because when you get big institutional investors coming through a capital market like that, it actually helps the balance of payments. And then you get this systemic improvement across the board. And so we're not there yet, and I think this is maybe something that we can all think of as part of NAFAD, because we've been really thinking about getting our capital markets to work better. We have over 30 in the continent, but we know that most of them are shallow and not active, right? So what can we do to really find a way to open those floodgates? That's the long-term challenge I see, but we've seen what it can do in some of our stronger economies in the continent.
Okay, thank you very much, Admas. I mean, for those of you in the audience, you have a glimpse into my Saturday and Sunday WhatsApp messages from Admasu, who comes up with with very creative ideas and always poses the question, Solomon, what do you think? But Admasu, there's one thing that a lot of times when we talk about mobilizing capital of scale, people think about it mostly in terms of long-term funding for infrastructure. However, we have a trade finance, deficit, a significant one, especially if we're going to be talking about intra-Africa trade. I know you're very passionate about trade finance funds. People don't think about, trade finance when they think about funds. So maybe you can talk about why you're excited about that and how that is also complementing reducing the trade finance deficit? Short answer. You have
Yeah.
30 seconds.
Yeah, thank you for that, Solomon. I think, we all know that the transformation effects are still in the making, and until we get more diversification in the different economies, there'll be limitations in terms of how much can be traded. But if we just look at two particular areas, if we look at power and energy, if you look at the big ticket imports of most African economies, it's number one is fuel, number two is probably fertilizer, and then you probably get a mix of medicine and some agricultural commodities like sugar. You know, nowadays you have power surplus in countries like Angola, Ethiopia. They can use these power pools in the region to wheel excess power across borders.
Yeah.
These are not small numbers, right? You can start moving, significant flows. And then you have refined fuel. Not that it's always a very sexy commodity to talk about in a world of climate change, but the truth is we're going to be using refined product for the next 20, 30, 40 years, right? It's in the energy mix. All the projections, even in the net zero perspectives, always have a portion of refined product in the mix. So Africa is going to be consuming a lot of refined product, whether we like it or not. That's a huge problem in our balance of payments. Yet Africa has a lot of this commodity. Is there any way in which we can actually do what we're going to start doing on electricity trade between power pools, between countries, and sort of plug that big hole? Because the systemic problems that we have in many of our economies is these balance of payments problems. This foreign exchange issue is just a big issue. And we will not be able to solve that unless we deal with the export-import imbalance. And so intra-Africa trade, I think, can really be ignited with a couple of these commodities. Of course, the others will follow. Food, I think AfDB has always complained about Africa spending $100 billion per annum importing food. It's crazy, right? This is the continent that has the most arable land, so much fresh water, so much capacity to produce food. $100 billion on food. It's crazy. So how can we unlock that? We have sugar surpluses in a number of African countries, but they can't move it across the borders. And you'll hear an African country nearby importing sugar from Brazil. Nothing wrong with Brazil. But if your neighbor's got excess sugar and there's non-tariff barriers that's making it difficult for the sugar to move or the milk to move, we have work cut out for us. But this is just to say we don't have to wait for the industrial transformation to happen. There's a lot of low-lying fruit around. And I think with what Mr. Dangote has achieved in Nigeria, I think there's a number of countries that have a lot of natural gas. We have participated in Mozambique's natural gas projects. We're hearing of very interesting prospects to actually pipe in some of that natural gas into landlocked countries, into Southern Africa. Now imagine what that will do for those that are, in need of energy, and many of them are importing in different ways. So there's a lot of opportunities to actually start making significant impacts if we're deliberate, intentional, and unlocking these big opportunities. And there was a big meeting in East Africa recently because Uganda is finally going to be hitting first oil, H2 this year. They have this pipeline going all the way to Tanga port in Tanzania. Crude oil going out, East Africa beginning to catch up a little bit with West Africa on those types of resources. But there's a big question on value addition. All that crude goes out, it comes back at twice the price.
Yeah.
The carbon footprint just of that operation itself is problematic. And we were saying from a net zero perspective, wouldn't it be better to just refine that crude right there in Central Africa, consume it there in Central Africa, rather than sending it 10,000 kilometers away as crude and then bringing it back another 10,000 kilometers? The carbon effect of that alone is very punishing, right? And then there's a question of the standard of fuels. A lot of the fuels we use in Africa are very low quality. These new refineries are Euro Standard 5. It really reduces the sulfur content and all of these things that make emissions very bad.
Okay.
So there's so many, climate positive effects by dealing with some of these things that sometimes we're afraid to talk about. And I think we should just be honest about some of these big tickets, because something like petroleum, not that I'm a big fan of fossil fuels, but when you look at the accounts of all of our countries, fuel is the #1 issue. And it's
No, and you're right,
displacing
Masu. Yeah,
foreign currency in a
we
big
haven't
way.
seen this in terms of crisis response right away. Look, thank you very much, but I want to give you the chance, one sentence on a key message you'd like to leave the audience with in terms of really mobilizing capital at scale. One sentence, very quickly. Excellency, you kick us off.
Thank you, Solomon. One sentence, I think when it comes to produce what we consume, when it comes to aggregate projects, when it comes to mobilize financing at scale, using fintech, tokenization, all these things, the one sentence is, as a member of government, is the alignment and the political will. We really need to be focused on those questions and to look at it not only at a national level, but also at a sub-regional and continental level.
Thank you. You know, my governor gets the chance for a long one sentence. The rest of you have one word. Please, Alain, go ahead.
The one word is execution. Execution. By the time we come back next year, we have to have executed large-scale transactions.
Thank you. Thank you, Alain. Alexandra?
And for me, it would be regional harmonization. Start working on regional harmonization to enable better funds flow in the region.
Thank you, Alexandra. Masu?
TDB Group has 2 trade finance funds that have aggregated. I'm just saying what Alain has talked about in terms of execution. We have executed, we have 2 funds. One of them is AAA rated in Mauritius. It's open for institutional investors, African or global. We actually have it in the works, so please, if anybody has investment appetite for Africa with a AAA rating in the context of Mauritius, come talk to me.
Thank you very much. Please join me in extending thanks to my panelists. Governor, Alain, Alexandra, Admasu, thank you very much. So I think we'll just take a picture. I don't know if they're yeah, we'll take a family picture. Yeah. And Alexandra has to come into the middle. Yeah. Yeah. Yeah, okay. Okay. Governor, thank you very much. Alexandra, thank you. Thank you. Okay. Okay. Good. Thanks. No, it was good. Thank you. So thank you very much. That was we've just completed the first panel. We now move to the second panel. Similar to movies, you have the Big Bang movie, but you have to have the second version, the third version. So we're going to go to the second version, and let me first of all invite Mrs. Shanti Bobbin. Shanti is the Deputy Assistant Secretary for Multilateral Financial Affairs and Development, Ministry of Finance in France. Shanti? Nice to see you. Next, I invite my brother, who I hardly ever see in Cote d'Ivoire, and I have to come all the way to Brazzaville to meet Mr. Felix Bibko. Mr. Felix Bibko is the chairman of the African Guarantee Fund. Yeah. Third, I'd like to invite Mr. Ziad Usalati, who's really one of our best fund managers in terms of private equity funds. We've invested in several of his funds, and you're my brother from the north. Thank you, Ziad. Fourth, I'm not saying this is a French affair, but I'm inviting Adama Mariko. Adama, please come on. And Adama manages FIX, Finance in Common, our summit. Please. So thank you very much, panelists. I know several of you were in the room, but I'll repeat the first question, which is a question I look forward to hearing the answers from all of you. Private and institutional capital remains underdeployed in Africa, despite rising demand. What is the single biggest structural barrier, and who's best placed to remove it? I'll start off with you, Shanti.
Thank you very much, Solomon. I think when we ask investors what are the structural barriers, they answer macroeconomic stability, lack of strong institutional governance, and need for a predictable business environment.
Coming after this panel is easy to just tick the box and go. But I will vote for two barriers in one. The first one will be the political stability and the legal environment, which is very important, I think. And the last legal environment, inclusive in the political stability, and most important for me is the risk perception.
Okay. Yeah. Ziad?
Yeah, indeed, as Felix said, I mean, it's tough to find or to build. At least I can build on what the others have said. So for me, I mean, the biggest risk, I mean, especially from the perspective of private equity player investing into SMEs in Africa, is of course, I mean, besides all the risks that have been mentioned, is the perception of risk. And unfortunately, in Africa, the perception of risk is very high, which actually we can prove, and it has been proven by many of us, that despite that risk, we can generate returns, we can build, grow, and employ Africans and provide sustainability. So really working on the perception of that risk, and I think further to the discussion, the earlier discussion, but also what we will say, there are ways to go beyond that.
Okay, thank you, Ziad. Adama?
Thank you very much. Actually, yeah, I would just add on the perception of risk. I think we can add on that as well the fact that there's a lack of, some instruments that help, dividing that risk. I may say the underuse of guarantees and, and blended finance instruments. Yeah, that's typically something that comes. As well, I mean, also accessing concessional capital is, I think, more complicated from some part of the world. That access when you have concessional funds that bring those additionality in the financing, I think it's somehow also complicated for African region.
Okay. All right, no, thank you very much. Shanti, I have a question just for you. How can multilateral and bilateral partners better align their instruments to de-risk investments, scale blended finance, and help African countries access affordable long-term finance? And then I think Adama, did comment on that a little bit. Yeah.
Okay, thank you very much. I think I've heard some keywords over the last days that will answer your question. I think for multilateral and bilateral partners to help unlock private capital and answer your question, they have to work as a system. We can just insist on complementarity, subsidiarity, coordination. Also, the president of the African Development Bank, Dr. Sidi Oultar, was also talking on harmonizing processes, go faster, co-financing, join forces. So we also do think and do want to foster mutual reliance agreements. I want also to mention that this is something we have on the agenda of the G7 French presidency this year. Also, building on what has been said in the previous session, to prepare, to be well prepared together for projects. This was a very important point. So this is the overall idea of working as a system. And then I was thinking about some key tools or key issues that have to be dealt with. I think first is country-led platforms and country plans, because if you say multilateral and bilateral, but also to help the countries, the governments to unlock capital and to help investors to come in, I think this is very important to have this country-led platform. Yesterday I was talking to one minister of economy and planning of the region, and he was telling me in his country was saying that there was a lack of coordination, so he was going to implement a new country platform. I think this was very important to show the need for good articulation between the African authorities and the partners, and this is a really concrete example. And then second point, I think, is there are instruments. Perhaps they are not always well known, especially when it comes to concessional instrument or catalytic capital. So something we think is important is also to have to do a stock take of what are the available instruments. Of course, we could always say we need more, but first we need to have a stock take of what is available, to let also private actors know what is available, and then, well, to be able to use. So there is a stock take exercise that, again, we are carrying out also with MDB's group. And then another point, I think, is information and data, because I've heard a little perceived risk. So as I was saying, my first point is that however, even though there is a perceived risk, there is also some risk, and we should acknowledge that we need more macroeconomic stability. In the previous parallel, Minister from DOBA was talking a lot of domestic resource mobilization. So there are things to be done to reduce risk, because there is a real risk. But then to deal with the other part, with the perceived risk, I think we have to rest more on information. And this, you may know, the GEMS database. This, we have information available on risk, on default rate, so we can make things more objective. And then we have to collect even more granular information, and also give information on performance of investment in Africa. And then data, you need to have it, to disclose it, and to use it. And perhaps I will not be much longer. I just want to say that it was only last week we issued a piece of work that are called Principles for Mutually Beneficial International Partnerships. I tried to summarize what is in these principles, and I will be able to share, obviously, with you and with the audience. And in a nutshell, it's what we think is to be done.
Okay. No, Shanti, thank you very much. I mean, one of the points you made was the multilaterals and bilaterals would have to work better as a system. Yeah, I mean, when I talk to African governments, they feel inundated. They feel exhausted having to satisfy each and every development finance institution. I mean, you cover the multilaterals. Your shareholders in the World Bank Group, in the African Development Bank, in EBRD. What has stopped us from achieving mutual reliance? I mean, and how can we solve it? Because if we don't, we can't work as a system.
Merci. Je vais faire aussi peut-être une partie.
Let me speak now in French for the benefit of our French-speaking colleagues. I think we have examples like the World Bank and the Asian Development Bank, and increasingly we have co-financing agreements with the Agence Française de Développement, which our African friends know very well. We have them with the World Bank. You know, we shareholders have to work to pull in the same direction, you know, and push for mutually beneficial partnerships. Another aspect which I consider important is procurement. I think there is a trend to say we need more, to be more stringent, we need more quality, we need to have a resilient infrastructure with quality criteria. But this trend really has to be consistent and apply across all MDBs. You know, we need to be consistent in each board of directors. So you're right. And then the country platforms, that is the role of the government itself, the Minister of Finance, the Minister of Economy and Planning is very important. And then there is another element I would like to touch on. There was a declaration on the mobilization of domestic public resources, a joint declaration of the Minister of Planning and Finance of the G7 with partners and public consultation. This contained a number of elements that have been mentioned, like digitalization, the fact that projects should have a longer term, and then there should be coordination between donors. And I think this is something that has to come from us, donors, financiers, and partners. You know, we have to be involved in coordination. So this is a shared and essential effort. Thank you.
Thank you very much, Shanti. Felix, how can credit guarantee and risk mitigation instruments be scaled to unlock financing for SMEs and infrastructure projects? But let's focus on SMEs while remaining financially sustainable and crowding in private investors.
Thank you, Solomon. I can talk only about SME. I don't know the other things. I think the objective here is that, based on your question, is to see how we can structure this credit guarantee or other guarantee institution to be able to reduce the funding gap that exists. It's common knowledge today that we spoke about it several times. The resources that exist in the continent is close to $4 trillion. Analysis are showing that almost 60% of these resources are sitting in the banking system. Now, the funding gap of the SME compared to this number is just $400 billion. Just $100 billion. So there's enough money in this continent to cover this gap. Why can't we do that? We can't do that for 4 reasons. Okay. The first reason, if you want to scale up, is, and we all spoke about it, is to see how we can reduce the perceived risk. SME, more than anything in this continent, is suffering from this perceived risk. Sorting out this perceived risk need for us to be able to change our way of doing things, change the operating model of the guarantee business, and strengthen more the risk framework. That's important. Once done, you can easily increase the willingness of those who have this money, I'm talking about the banking system, to come to the market. With a perceived risk, we can't do anything. We have to add to the perceived risk the real risk. I like what the former panel said. In this continent, it's easy for a bank to book its loan to an SME, to P&L, than going to the legal route. It's less expensive for him to book in a P&L to go into legal route. So we can't, even if we want, we can go there. So this barrier, like you are talking, that is embedded in the perceived risk has to be handled before we move on. So that's done. Let's assume that that's okay, that is being done. AGF is working hardly to make it happen. We need now to build our capacity. Today, look at my operation. We have around $10 billion of guarantee requests waiting in the pipeline. Our shareholder fund is close to $300 million only. Whatever you do, you can't match it. $300 million. And this $300 million is already committed to the existing portfolio, meaning that you run away. Well, if you call me for another guarantee, I just pick your call. I don't pick your call. That's the reality. So what can we do? We see if we reduce the perceived risk, helping the lender to take more risk. If we reduce the perceived risk, bank will be happy to go to this SME business because, by the way, SME business give more return than any other business. The return are higher. So there is no bank that doesn't have to have a return. So just reduce the perceived risk and we see how we do it. $300 million for $300 million for $10 billion is nothing. So what we want to do at AGF, that's the second issue, is to see how we can use our current public resources to absorb the first loss. The current and the coming public resources to absorb the first loss. The remaining senior debt will be highly attractive to any investor that I can solve the other investors like pension funds, like some philanthropic institution, impact fund, and even some private sector, real private sector, because they are the kind of matters that will help us to come to test the SME risk. We cannot decide the perceived risk is finished. We can come gradually to understand, but in reality the risk is perceived, is not real. But this kind of arrangement using the innovative blending finance model give a kind of comfort to them to go and experiment, I like this word, with us, this role and say, it's not that bad. We are just believing that, like a lot of things in Africa, I'm sorry. Build your capacity, build your shareholders' capacity is now the key things to be able to move. Having done that, the guarantee business is a specific business. It just gives comfort. We need to make sure that we give the comfort, we continue to give the comfort to the lender, thinking about the banks and the others, and also the investor. Securing a rating is very important. The SMEs to prepare the file in line with what the banks want, and the citizens want. In fact, we are the vis-a-vis of the bank and not only. So we are doing that in several countries, and we pay for that. It's part of our capacity building. This is why when we raise the money, the capital, we raise the capital once, and we ask our shareholder to add another 10 to 20% for this capacity building fund, which for us is also our re-guarantee. Somebody asked me, how do you guarantee people? How do you guarantee? How are you guaranteed? And I say, by the capacity building.
Okay.
This capacity building reduces the risk and reduce the default and help these two people to be able to know each other and to continue. And then we have succeeded.
Okay.
Without that, without the funds that we are requesting that exist in the continent, we cannot do anything. And we think, talk, nothing will happen. Yes, infrastructure are important. The trade is our basis. But I strongly believe that the real engine of the growth in this continent is the SME. And we tend to forget it. Thank you.
No, thank you very much, Felix. So the Africa Guarantee Fund is a Pan-African institution. So the $10 billion of demand for guarantees you mentioned is really Pan-African. So we need to find a way to help AGF better recapitalize? What are your plans in the short term to recapitalize beyond the 300 million?
Yeah.
Very quick, yeah. And
And
how can we help? Because there are investors in this room.
you asked me the most important question. You want to be quick. I will try in two sentences. As I said, the first thing is to find our government or other public sources to come to absorb the first loss. Okay. What you are doing today, you are talking to some African governments, South African institutions, government related, to be able to provide us with this first loss tranche. That's the basics, that's a good atlas. Based on that, we are discussing with some institutional investors, like the pension fund in the continent, and some philanthropic institution or impact fund that exists in the continent, to come to take the senior debt. We will go shortly to a roadshow. As you can see, I can't see the road, but so we have a special department for fundraising at AGF to structure all of that. Objective being for the next 3 years, push the capital from $300 million to $1 billion. And 2 and 3 years later, to go to $5 billion that will help us to unlock at least $100 billion in the continent. But that's not enough. We can't do all alone. And by definition, a guarantee business is a risk-sharing business. The platforms that the AfDB is suggesting is to see with our sister guarantee business in the continent or outside the continent to syndicate the guarantee business for risk sharing and for scaling up also. Syndicate this guarantee business in syndication, in re-guarantee, and sometimes in co-guarantee. So these are initiatives that the AGNF management is working on it, and where the board insists seriously because we need to reduce this funding gap by minimum 50% in the next 5 years. That's our commitment.
All right, no, thank you very much, Felix. I'm looking at Shanti because Shanti has also decided to support ATD, and ATD will be a great partner for you. So Shanti, this is the way the NAFAD system can work together because ATD will be able to risk share with AGF as well. But thank you, Felix, and we are going to help capitalize as well. Yeah.
Is that a commitment?
That's a signal. That's a positive signal. Ziad, what lessons from private equity investing across Africa best inform how to unlock more growth stage and impact-oriented capital on the continent? I know we've talked about this, but it would be good for you to give your views to the audience.
Sure. Thank you. First of all, I'd like to insist on the fact that SMEs are key. These are the backbone of the economy in Africa. I mean, they employ people, they pay taxes, they help the local communities, so that's where most of the funding should go. I think as Africa Invest, I mean, investing into SMEs all over Africa, first of all, the return in terms of SMEs has been on average like 2 times, so it's not bad. Again, I mean, people hear about the risk of Africa, etc., but if you do and invest into the right SMEs, you help them grow, you put in place the governance, and you make them formal. I think one of the issues of Africa is that the informal economy is huge. And I'm going to say, I mean, it's obvious why in terms of paying taxes, etc., but it goes beyond that. Actually, Africa needs, of course, I mean, more capital, foreign capital, but also local capital. And local capital is key. Many of my colleagues here has touched on that. Today, there are around $1 trillion sitting between sovereign wealth fund, between insurance companies, and also pension funds. $1 trillion, that's huge. I mean, if you unlock just 5% of it, it's going to be around $50 billion. I mean, unlock it to finance SMEs through private equity, private credit, helping also AGF, because AGF is playing a huge role. It's not because Felix is here, but I can tell you that we use AGF, and it really helps a lot in terms of financing, especially the smaller SMEs or SMEs that are not there, but even, I mean, much more mature SMEs. I mean, this local financing will go to 1.5 trillion by 2030 and around 7 trillion by 2050. So that's a huge amount. And we shouldn't overlook that. And how to get those amount of funding, or at least 5% of it, or 2% of it, to the private sector and financing the SMEs is, of course, I mean, through some mechanism that would lower or at least give some comfort to those pension funds, because again, pension funds, it's managing money for the long term. It shouldn't take a long risk, a high risk, but moderate and low risk. So there are ways to do it. I think in terms, first of all, they should diversify and not only finance governments. I mean, 80% of it is financing the local governments. Which is not, I think, the way to do it if we want to build wealth in the different economies. And we've tried it. So I'm talking about cases where we've put in place vehicles with blended finance, where basically one of the latest actually fund, which is private credit, that we put it in place with a blended finance mechanism. So the senior tranche has gotten a BBB rating from Moody's. So that gives a lot of comfort to other commercial investors from within Africa or beyond Africa to come on board. And actually, we're talking with a lot of pension funds, mainly from Kenya. Actually, pension funds from Kenya were among the first to invest with us like 10 years ago. And we should really salute them, because they were among the first to take the risk and go to this asset class. So what I'm saying here, and this is maybe something where AfDB can help a lot, is to put in place the right instruments, the right mechanism to lower the risk to these funds, to the 50 billion, if we take 5% of the sitting funds, to channel them to the private sector, and over double, triple that amount, I mean, as years go on. So for me, I do believe that infrastructure, financial infrastructure is key. It builds a platform, it builds the basis, and this is a question that you asked, Solomon, to the minister from Central African Republic. But afterwards, I mean, it's people like us, like all of us around here, to finance those companies that employ people, that pay taxes, that export and provide that sustainability that the African continent needs.
Okay. No, thank you very much, Ziad. I mean, look, one of the things that always comes up in terms of scaling up investments in private equity funds, clearly the commercial principle of return, risk, reward is there. But a lot of people have questions on the development impact that you're actually delivering. So this is an opportunity to speak for the asset class in terms of the impact that you also deliver. And you only have 30 seconds to answer that.
Sure. No, thank you for giving me this opportunity. I'm going to share, I mean, I'm a very concrete person. I'm an engineer, so I'm going to just provide numbers. We created around 750,000 jobs. We grew the export by 2 times of our portfolio companies, 2 times also in terms of taxes paid. And we enabled over 500 million people to get access to finance. So these are very concrete numbers that we generated since inception.
Good. Thank you very much, Ziad. Adama?
Yes.
Finance in Common brings together more than 500 public development banks with a combined balance sheet in trillions of dollars. How can that network be better mobilized to crowd in private capital for Africa? And where is coordination between public banks still falling short?
Oh, thank you very much. I've been hearing the discussions. You find public development banks at all the stages of this discussion. Some of them are investing in African-based. Others are guaranteeing those portfolios. And of course, they support government policies. You have more than 500 public development banks in the world. They don't have all of them the same mandate or the same size, etc. So there is a big fragmentation in that ecosystem. But mainly in the international fora, when people refer to development banks, they refer mainly to MDBs, and it has become systematic. So the first step was to map out where they are and what they mean. Within those 500 and plus public development banks, 100 of them are in Africa. actually. So 20% of the ecosystem of development banking are in Africa. From the African Development Bank to the national institutions, somehow all of them don't have a banking mandate, so it can be a local fund to fund specific public policy, supporting their governments. But just to say, the main problem is their size in Africa. Out of these 20% of development bank in the world located in Africa, they only count by 1%, to the total asset of the development banks in the world. So if you compare to the G20 countries, for instance, they concentrate 80% of the total asset of the development banks in the world. So it gives the story where those development banks are investing in their own economies for centuries. And has supported the growth on those economies. In Africa, it's mainly underused, and that's, I think, where the NAFAD process is very interesting in how to organize this financial public architecture in Africa to support African growth. And I think that's definitely the work we are doing within the Finance in Common process to at least represent this community of development bank in the financial architecture, giving those data on what they do, what are their mandates, and how they invest in the economies. And of course, that's where also we can support some initiatives and showcase the bottlenecks we are having. And if you look at the case here, and it has been mentioned by a few of you, the first point is how we make sure that this system is organized and how it is deploying in two levels. One is origination, and the other is execution. So in the origination level, if you originate projects from Paris, Washington, London, Brussels, somehow you may have good projects, but do you have enough? I'm not sure. And the reliability on those also projects at a country level is somehow, not really aligned. So having the national development banks being involved in a process of originating the projects, based on the country's policy, I think is a step to go. Because you see the national plan, development plans somehow are published by the countries, but little of them are mentioning their own national development banks. They rely a lot on the support they can get from international financial partners. And of course, I think having skin in the game, having a financial system that is in the country, aligning the interest as financial institution with the international financial institution is a way to organize also the investment process in Africa. So at the execution level, of course, having a good development bank, which is at scale, is of course to making sure that the debt burden somehow is not growing with a misuse at the project level. So having a development bank that is following the execution is also to make sure that the impact is there, it's the right way to invest, and those also just, is a way to just, a good way of proceeds in this discussion.
Okay. No, thank you very much.
Okay, do you
I
want
have
me
a
to
follow-up question for you. It's a yes or no question. You see the value of NAFAD in helping with, aggregating and bringing together the various development banks? Yes or no?
Yeah, I see very much value, and I think there's two instruments that NAFAD can also keep pushing. Yeah. On the guarantee discussion, it's really, important in a way that the perception of risk is also just a lack of the risking instruments, and guarantee brings, somehow just the perception that you will be covered. But the problem is at the systemic level, the fact that there has not been incentive for guarantee within the ODA framework. You had loans, you can account by disbursing and even engaging it with some conditionality, and of course you have the grants. But for guarantee, you had to wait the default to count when you disburse the default, so you count as ODA. If we change the incentives for the countries, I think there can be a more commitment on those issues to also keep unlocking the fact. In Africa, what I see, just one final word, what I think is missing though is how we push these capital markets to also be a way to mobilize private capital. And that's the public development banks also can help with, having a private, a capital market where you can borrow in local currency, that is a way to de-risk, where you can have an anchor investors as development bank lowering the price, and of course having SMEs that have exit plans in this business.
On that note, thank you very much. We've run out of time, so I can't do my last sweeping question, but we've heard lots of good views from different perspectives. So please join me in thanking my panel. Thank you. All right, I think we're done. Yes, we're done. So, yes. Okay. All right. Thank you. Thank you. Yes. Yeah. Remind all of you that, our next knowledge event would really be at 2:30 p.m. today. So please, you're all invited to join. And I hope you enjoyed really the panel discussions from different perspectives. Thank you very much. We'll see you at 2:30 p.m. Thank you.